Good morning, good evening, good afternoon, depending on the part of the nations you are at the moment. Welcome to the Global Trader. Today, another great day. In case you've not subscribed, please subscribe, press the notification button for all our updates. And this platform, this channel is basically education to educate you more about forex trading, and it is being simplified. It is being simplified. Easy way to get to begin to trade forex. Yes, some other platform might make it a little bit complex and make you feel forex trading is very difficult. There is nothing difficult about forex trading as long as you open up your mind and you are ready to assimilate and also ready to gain knowledge. Forex trading will open you up to a lot of opportunities. You will know what is going on around the world. You will know the economy of each nation and all that. And it's very interesting, and you make profit. You make good profit. So today we'll continue from the last class. Last class we're talking about pips, talking about base and quotes. And today we'll be talking about, in case you've not listened to that lecture, you can go to Forex for Beginner 2A. That's the where we're continuing from right now. And today we're talking about lot sizes and leverage. Lot sizes and leverage. Now, what is lot sizes and what is leverage? They are very vital in forex trading. When it comes to what we call money management and risk management, you cannot run away from this topic. Why? Because if your lot size and your money management is being mismanaged, you're bound to crash your account. It's two-way thing. Either you make more profit, or you lose, or you make lesser profit. It depends on the one you choose. One thing about forex trading is all about you deciding what you want. So today let's talk about lot sizes. Lot sizes is simply, I'm looking for the easiest way to break it down. Lot sizes is like what you stake to be able to get your profit. And remember, what you stake depends on the amount you put into it, or the amount you are willing to sacrifice out of your capital to trade. That's the meaning. Or the amount you are willing to get. So lot size, we have them in three size. We have micro lot, we have mini lot, and we have standard lot. Your lot size can either make you or destroy you. And we have it in units. We have in size, we have 0.01, which is the smallest. We have 0.1, which is meaning, and we have standard lot, which is 1.0. By the time we start practical, I'll begin to show you how these things work. Then in units, in unit, micro lot is 1,000. In mini lot is 10,000. While standard lot is 1 million, but that's 100,000. Then we have a movement value 0.001. That is their movement value. So for you to get profit or loss now, what you just do is you multiply your movement loss, which is your pip. You calculate your pip times your units. That's how to know your lot size, to know your profit or your loss. So that will be 0.001, which is your pip. That is one pip times 10,000 times 1,000, which is a micro lot size, which is in units. It will now give you 10 cents, 10 cents per pip. So when you move one pip, that means when you take one step, either backward or forward, if you're taking one step forward in positive position, that will be plus 10 cents. Then if you're going towards the negative direction, that is minus 10 cents. Very simple. Then in mini lot, you have 0.01, which is the pips times 10,000, which is the units in units. It will now give you $1. So that means in mini lot, if you move one movement forward, you make $1. Then if the market goes one movement against you, you make minus $1. Very simple. So standard lot size now is 0.001, which is the pip, that's one pip, multiplied by 100,000, which is the unit in units. It will give you $10. Meaning that if you go forward one pip, one step forward, you make $10. If you go one step backward, you make minus $10. So it's that you in forest, is that you're in positive or you're in negative. You must choose one. So one of the advantages of this of 0.01 over 0.1 or over 1.0 is 0.01, it takes a longer time before your account can crash depending on your capital. Yeah, all these things depends on your capital. Now, mini lot size also, 0.1 also is better than 1.0 depending on your lot size. For example, somebody that has a kiosk, just a kiosk, and someone that has a supermarket, they are both operating at different level. So somebody that has 100,000 naira or $100,000 and somebody that has $1 million to trade, they are both operating on different level. So if the person that have 1,000, $100,000 wants to trade like somebody that has $1 million, he's taking a higher risk. So he'll be forced to use a lot size of somebody that has $1 million. So by the time he's using the lot size of someone that have $1 million, that means the $100 is open to higher risk. That is just the difference. So when you are making 1 naira, so when somebody is making 10 cents using one lot size, using micro loss, a mini micro lot size, the person using mini lot size begin making $1. The same way, someone that have a small shop and somebody that have a supermarket, they cannot make profit the same way. Their profit margin is different. A wholesaler and a retailer, their profit margin is different. So your capital determine the kind of lot size you can use. And now the broker can also give you, we're going to leverage now, what we call leverage. The broker gives you an opportunity to trade as if you have a bigger fund. For example, you have a shop, but now the bank will now give you an opportunity to trade, to do your business as if you have a supermarket. So you are leveraging on the bank's finance to open up a lot of other opportunities for you. Also, when you want to trade, let's assume you have $100. You have $100. Now the broker will give you opportunity to trade as if you have $1,000. Also note that the way your leverage can make you, that is how your leverage can destroy you. So you must be very, very careful when you're using leverage. You must be extremely careful because your leverage can make you and your leverage can destroy you. So by the time your broker gives you opportunity to trade as if you have $1,000, you have $100, they've given you the opportunity to trade as if you have $1,000. Sometimes you might abuse it. You begin to open trades, begin to do anyhow in the market, and before you know it, your account is gone. Your account is gone. So I just gave you just a brief explanation. Right now, let's go into the what is written here to the slide. You are probably wondering how a small investor like yourself can trade such large amount of money. How can I have $100 and I will be trading like somebody that has $1 million or that has $1,000? You can be wondering that. Think of your broker as a bank who basically fronts you $100,000 to buy currencies. All the bank asks from you is that you give it $1,000 as a good faith deposit, which it will hold for you but not necessarily keep. You see, they give you the opportunity to trade as if you have 100,000. The bank will give you $100,000, but you have put in $1,000. So you begin to trade like if you have $100,000. You have a shop, you have 100,000 to invest in your shop, but the bank say, okay, you leverage on for because you are customers and all that. They give you the opportunity to do as if to trade as if you have what 1 million naira. So in that opportunity, with this kind of opportunity, you can either take advantage of it, it will make you or destroy you. Sounds too good to be true. This is how forex trading usually leverage works. Let's show you, for example, we have understanding your trading window. We have in so that's how the forex market works. So now let's go into understanding your trading window. By the time we start practicals, I'll show you more on how to set your leverage in accordance to your capital, because sometimes you can go and over leverage your account, which is a risk. So you must make it proportional and you must balance the both sides. Maybe you have $100, you should not be aiming to trade like somebody that has 2,000 or $5,000. No, it might either destroy. So it's better you trade as if you have $100, better you trade as if you can leverage as if you have $500. It's better. or as if you have $300. So the more risks you try to avoid, the better for you. It's better you are making one naira or one dollar every day than making 10,000 naira, $10,000 today. Tomorrow you are now making you are now losing $20,000. No, so it's better. So the trading window, understanding your trading window, this we are gradually swinging to the practical aspect. You can see we have the balance, the amount. The balance simply means the amount of money you actually have when you have no open positions. What is open positions? Open position is simply when you place a trade and the trade is running, that is open position. These are some terminologies or terms that we use in forex trading that you need to understand. For example, you can see GPP USD sell 1.00, which is a which is a standard lot size. You can see we have $22 as profit here. So now there's an open position. Balance the amount of money you actually have when you have no open position. So when there's no open position, that is what you have the balance. Then equity is simply, okay, we'll still go forward. The number changes based on wins and losses. So your number, the balance usually change. For example, if you close this one in profit, what you're seeing here in profit, it will change to $10,000 and 22, 10,000 and 22. But if you close it in loss, the balance will certainly reduce. We also have equity. Now, this number contains your balance amount and your profit or loss. So equity is your actual money when you have your trade open. When the moment you open your trade, the moment you open positions, don't your balance is not your actual money. Your equity is your actual money. So you must guide and protect your equity jealously by putting money management into place. So this number contains your balance amount, your profit or losses. If you are up $22, it will show here. It will show there. This number moves when trades are open. So equity is equals to balance plus floating profit or loss. So it's either you are in profit or in loss. So it's by the time you now close your equity, that is when your balance will now be equal to your equity. But as long as you have a trade, a open position, you are still in the market, your equity is your actual money. Now let's go to free margin. Then this number represents the available money you have in your account to trade with and open new position. Free margin equals to equity minus margin. This number represents the available money you have in your account to trade with. So free margin is simply, okay, you are trading. That is the amount that you have to trade with. That is the amount you can take into the market and trade with. So your free margin is equals to equity minus margin. That is this minus this equals to free margin. Then we'll go next. With no open position, equity, free margin, and balance should all be equal. So by the time there's no open position, you discover that your balance, equity, free margin will be equals to each other. They will be the same when there is no open position. Balance equals to equity, equity equals to free margin when there is no open position. That means when you close this particular sell market. Also, margin level, this is the ratio between equity and margin. It's just the ratio between the equity and margin. That's equity, this one, and margin. It's just the ratio in percentage. It's just the ratio. When your margin level reaches 100%, you may not take on any new positions and are in danger or having losing position closed immediately. Broker may close out biggest loss losing positions first. Never let 100% reach or below. So it's better you avoid it. Better you avoid it not to get to that 100% margin level. So we call it margin call. That's when your account is about to crash. So when you get to that point, then the broker will even notify you. They'll send you a message immediately that your account is at danger. They'll be showing you red light where you can see green light, green, blue light, blue color here. It will be showing red, 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 red. That's danger sign to tell you that you're about to crash. So margin level, stop out level. Once the margin level falls below 100%, your brokers your brokers may begin to start closing out trades, starting with the biggest position. So when your margin level is getting to 100, your broker will just help you and begin to close out trades for you. So margin is your down payment needed to get you in the trade. This is non-leveraged money. So you can see here we have balance. This is where we have it. This is the desktop view. This is the empty phone desktop. This is how it looks on the desktop. This is how it looks on a mobile device. The one above here is the one that looks, that's how it looks on a mobile device. This one on the desktop view, we have balance, we have equity, we have margin, we have free margin, we have margin level. And whatever you see here is either in profit or in loss. So today, I think you have to go digest what we've learned so far about lot sizes and leverage. Please, in case you have any question, feel free to ask and feel free to send us a mail. When next we come, we're going to talk more on types of orders. Why I don't want to bombard you with so much tonight, this evening, today, is because sometimes it can get confusing if you don't take it one step at a time. But always press your notification button and you get the next class on this particular on types of orders. We'll show you type of orders. I will explain to you what it means, and from there I believe you will have an understanding by before we swing into practical session. In case you have not subscribed to this channel, I'm sure the channel has been a blessing to you. Please feel free to subscribe, press the notification button, and always remember to like, comment, and share. Thank you very much. Remain ever blessed. This month we favor you in Jesus' name.